Awesome. So today we are going to chat about stock research. I'm firstly going to show you and chat a little bit about how do we find companies. I think that is something a lot of people struggle with. And there's no shame in, using, let me just see if I can, just want to see if I can use my, it's fine. I don't need the laser pointer right now. So many people struggle with stock research. Most investors started investing during lockdowns or during COVID. Now, the downside to that is you started investing during a bull market, okay? A really, really big bull market. And if you were lucky, you started in March of 2020, you might see a lot of gains right now. Some of you might have, picked up some of these stocks later in 2020, or you might have picked it up, in 2021 when the share prices were really, really high. And you overpaid, and you're seeing flames right now in your US portfolio, potentially also in your JSE portfolio. Okay, so and you might not have done research. Now you don't know, should I wait for these stocks to get to zero and sell them? That is postponing the pain. I'm not saying sell what is in your portfolio. I'm saying research what is in your portfolio and then chuck out the stocks that you don't believe in. You can't just chuck out anything, randomly, because you made a decision. And, Redwan from Think Markets, he always calls it paying your school fees. And paying your school fees means making losses, learning lessons from those losses. That's paying your school fees. So let's jump in to today's webinar. How do you find companies to invest in? There isn't a magic formula, guys. As retail investors, and when I say retail investors, I mean people like you and me. I don't mean the stock traders or the institutions, that have access to massive information. They have they have so much at their disposal. As retail investors, we need to use what we've got. So the first way, and it's probably the most popular way that most people find companies to invest in, is through, a clue. Somebody gives you, I just want to see what this thing does here. Okay, there's my laser pointer. Okay, the first thing is they get a tip or a clue or a hint from family or from friends or from social media, and they invest. That's the biggest mistake you can make, because this is my slide one. Not even sure how many slides I have, but that is that's the tip of the iceberg. It's literally, there is so much still that you need to do before you invest, because you might now see, Sol bought Tungela. I started buying Tungela at like 29 Rand, 30 Rand a share. I averaged up, some of my shares I bought over 100 Rand. My average cost is around 70 Rand, 75 Rand for Tungela. Now you see, hey, Sol has bought Tungela and now she's up, 400, 500% on the share. I'm going to buy two. That's a horrible, horrible idea, because the stock market has a fundamental rule that we buy low and we sell high. When you do that, when you say Sol bought at 75 and she's up 500%, I'm also going to buy. What you are telling yourself is, I'm going to buy high. Where are you going to sell? Are you going to sell higher? There's no such rule. Are you going to sell low? Because I can almost guarantee you, if you buy high, you're going to sell low. So Joe, don't jump on bandwagons, okay? When you get a tip or a clue or a hint, you still need to do research. And that's what I'm going to help you with today. And I'm going to show you examples. The next way you can find companies to invest in is a bit more sophisticated. It's called a stock screener, okay? And to use a stock screener, you have to know what you're looking for, because it's like a filter. It is, you need to go in there and you need to tell the stock screener what you're looking for. So I wasn't planning on doing this, but I'm going to do it anyway, because I am me. Let's go in and we say Yahoo stock screener, okay? There are many, many stock screeners. Yahoo is just one of my favorites. So let's look at Yahoo. If you say Yahoo stock screener and you go in on the first one that pops up, you're going to get in here, okay? Now, this is what the screen looks like. You're going to say, create a new screen. Screen like this is going to come up. We are talking about stocks today. Another name for stocks are equities, okay? So you're going to say, I want to do an equity screen. Then the next screen comes up and it has a whole lot of boxes, even boxes that you can't see. Now, it defaults to the United States because Yahoo is a .com company. Okay. Now, let's say we are South Africans. We want to look for a South African stock. We take out the United States and we add South Africa. You can go and type it in there, or you can search for it. You can scroll till you get there. Then you say South Africa. What has happened now? On the side here, it now tells you there are 446 listed instruments in South Africa that you can choose from. Lord knows you cannot research 446 companies. Okay. The next one, it will tell you what is the market cap. And we're going to talk about this word a lot today. Market cap means the size of the company. Okay. So if you look at a company like, let's say a company like the Purple Group, let's say the Purple Group is worth 10 billion. That's the market cap of the company. If you look at a company like Naspers and it's 1 trillion rand, that's the market cap. That's the size of the business. Okay. So let's say we don't care about the size of the company. We also don't care about the price. Something that is very important is the sector. Let's say you built a FOMO portfolio. You copied people, and in your portfolio, you're just sitting with a whole lot of mining stocks. Let's say you don't have any REITs, real estate investment trusts. Those are companies that owns properties, and the dividends that they pay out is actually rental income. We call it a dividend, but it's actually rent that you're getting, because REITs own properties and then they collect the rent from the tenants. So you can have, you can have commercial properties like malls, etc., etc. You can have office blocks. You can have residential properties. You can have industrial properties. You can have storage facilities. Those are REITs. They collect rent. Let's say you don't have REITs in your portfolio. Then we're going to go in there, and what comes up? Look there. There is the 13 sectors, 11 sectors that you can potentially choose from. We are going to choose real estate. Okay. Now look what happened. It's now telling you there are only 44 real estate companies that you can choose from in South Africa. Okay. Now there's a very neat little block here that says add another filter. I want to add another filter because what is the most important thing about a REIT is we want dividends. Okay. Now, can you see all this information here? All this information is, they say popular filters, they have like market cap, ownership, they talk about short interest, valuation metrics. We're going to talk about valuation a lot today because you guys like paying too much for things. Profitability ratios, the debt, liquidity, all of these things. You don't have to know everything. We are here for the dividend. Okay. So here it has a button that says forward dividend yield. It means the potential next dividend of the company. Okay, now we've clicked it, and there a little button has come up now, a little block. You can say, I want a dividend greater than, less than, equal to, or between. Let's be greedy and say, we want a dividend larger than, what's inflation now? Inflation is 7.4%. So we want a dividend larger than 8%. We're not interested in lower dividends. Now there's 23. 23 is still a lot. Let's be greedier. Let's say 12%. We want a dividend of 12%. Now it's telling us there are 10 REITs in South Africa, 10 real estate companies that's going to pay you a dividend of 12% or higher. Let me tell you something about REITs that a lot of people don't know. Real estate investment trusts do not have the option of canceling dividends or of postponing dividends. They can potentially pay a lower dividend at a later point in time, but they can never say, we don't feel like paying a dividend. And you know why? Because they have very special tax regimes with SARS. They are obligated by law to pay out more than 75% of their profits. So if they make a profit of R1 million, they have to pay that rent to the shareholders. A company like Discovery or Sasol or Kumba, a normal company, they can say like, hey, but we didn't make a lot of profits this year. We're just not going to pay a dividend. And Discovery did that during COVID. Sasol did that during COVID. They canned dividends. REITs can't. So if you are an investor that likes dividends, think about putting REITs into your portfolio because it is a consistent income flow. Okay, now let's say, show me these companies. Who are they? Who pays a 12% dividend in South Africa? Redefine Properties, Vukile, Fairvest, Octodec, Baldwin, Accelerate, Depula, how do I say this name? Endlo Place, SA Corporate Real Estate, and Texton. There's the 10 companies that's paying you a dividend of, they told me there's 10 on the list. Okay. And now, once you get here, now you have to do research because you can't just say, I'm going to choose Baldwin. What if Baldwin destroys the share price? What if Baldwin is busy selling off properties? You know, what if you already have residential properties in your REIT portfolio? Because diversification is important across sectors. But what I also do in my REIT portfolio is I say, I want malls, I want offices, and I want, residential properties, because people always need to live somewhere. People might not go to malls, People might start working from home, but people always need some way to live. So currently, you don't know what these REITs own, and that is where the research come in. But let me show you something that I really like about Yahoo, why Yahoo is my favorite stock screener. I'm going to click on Vukile. It's no secret. Anybody that follows me knows I am a Vukile bull, okay? Vukile owns malls in South Africa and Spain, 50% in South Africa, 50% in Spain. I love that we are getting rental income in euros. Those euros gets converted to ZAR, and you know, it's just a diversified portfolio. Now, when you get here on Yahoo, you can see, here's the little bit of summary information. You can see here's the actual dividend yield of around 14%. You can see, you know, there's a lot of information. You can even go to the financial statements. You know, you can look at the financial statements. The financial statements always starts with the oldest year there, and it's going to the newer years here. You can look at the revenue, you can look at the cost, you know, you can look at the profits, etc., etc. If you look at the top here, you can also look at the balance sheet. Is my REIT selling assets? You know, because the assets bring in the income. So let's look at the balance sheet. They have grown the assets from 35 to 40 to 35 to 35. So it looks like a consistent, you know, a consistent balance sheet. The other thing about assets, guys, is assets gets fair valued. Okay, so your REIT might be selling properties or buying new properties, but because of the valuation of the properties, you might not see it as clearly in here. I'm gonna go to the thanks, Nadia, saying she's already learning so much. Yes, the recording, Muketsi, is going to be on YouTube, okay? It is, let me make sure, it is being recorded. I'm going to post it on YouTube. I'm not a YouTuber, guys. I just use YouTube. I just abuse it to post my lessons there, so that if people miss something, you know, they can get it later. So this is the stock screener, okay? You can search for anything in a stock screener. If you come here and you say, you know, I don't have enough technology stocks in my portfolio, let's go back quickly, and then I show you guys something. Let's say you want tech stocks in your portfolio. Normally, the United States have the better tech stocks. We can't deny that. Let's say you want technology stocks. Now we have to take out real estate, okay? And we have to take out the dividend yield, because finding tech stocks. Can you guys see the difference between the size of the US market and the South African market? We have 446 companies. I just have USA in here now. 15,800 companies. That is overwhelming for a new investor. It's impossible, people. So let's just play around with it, because I want to show you guys something. Let's say we go to tech, okay? Now it's telling us out of those 15,800 companies, 1,500 of them are technology companies. But tech is a very wide field. So what I want you to know is, go to the industry, because now it's going to tell you, you know, do you want semiconductors? Do you want, why is this thing going to mining? I did not put in mining here. If I say the sector and I say tech, okay, there we go. There was just a little bug. Okay, so now you can see there is IT services, there's infrastructure, software infrastructure, there's hardware, there's electronic components, blah, 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 blah. There's solar, that is very, very, you know, good for the environment, that's exploding right now. But let's say you don't have a semiconductor company in your portfolio. You don't have an NVIDIA or an AMD or let's just say you don't have a semiconductor. Let's look for semiconductors. Now it's telling us out of the 1.5, only 92 are semiconductor companies. You can't research 92 companies, fam. You really, really can't. So I'm going to tell you what I do. I would say add another filter, and we're going to talk about this later. I hate investing in unprofitable companies. So what am I going to do? I'm going to say, go to the income statement. Did I go past it? Oh, there's the income statement. And give me the net profit. Okay. I want a profitable semiconductor company. So their profit must be bigger than 0. Now it's telling me there's only 58. Okay. What if I then say, please give me a dividend of 5%? There's only 4. 4 is doable. Who are they? So can you see, why does it say my criteria has net income larger than 0, dividend? Something has changed here. I don't know what. At the industry, semiconductors. Something's a little bug here this morning. I don't know what. Okay, so it's telling me, guys, there's a little bug in Yahoo this morning. I don't know what the hell is going on because it keeps taking my stuff out, but just be patient with me. And it did come up there. Okay, so it's giving me all the bloody semiconductor companies, but you see what I'm getting at. You know how to use a stock screener. You cannot use it if you don't know what you're looking for. Okay, and that is where we are going to chat today. Okay, let me just quickly see YouTube channel. If you follow me on any social media, there's a link called Linktree. Okay, every single social media page that I'm on, I have a Linktree link. And if you click on that Linktree link, you're going to find my Instagram, my Facebook, my YouTube, my TikTok, my email address, everything is there. Okay. I just want to see if I'm not. Okay, thank you. There we go. Is there a reason for the tech sector why I put 5%? There is absolutely 0 reason. This is an example. You can put 10, you can put 5, you could put 2, you could put 1. It's up to you. This is just an example. Okay. Jane, someday I'm going to lecture at Varsity. One of my goals is to teach at Gibbs someday. But I want to teach what I'm teaching right now because I believe that everybody is showing entrepreneurs how to make money. Gibbs is very guilty of this. Most institutions are very guilty of this. We teach entrepreneurs how to make money. Nobody teaches entrepreneurs how to keep money and how to grow money. And that's why tenderpreneurs go freaking bankrupt within the first year of business, because they get a huge tender. And what's the next thing? They are at Conca. They hire party buses. We need to teach entrepreneurs, if I make 100,000 Rand profit, 10,000 of it needs to go into the stock market. It needs to go into cryptocurrencies, needs to go into my retirement portfolio. Our tertiary education in this country is as bad as the basic education, because they think, oh, if I show them how an income statement and a balance sheet works, they're going to be amazing entrepreneurs. Entrepreneurs fail. We have an 85% entrepreneurial failure And it's because they do not know how to manage the profits that they are making. But that's a story for another day. You guys must pray for me so that someday I do teach, and especially female entrepreneurs, how to keep and grow their money for the next generation. Okay, let's go back to our slides, because me, I can digress like a mother. Okay, now let's go over. You now know when you get a tip or a clue away in from social media, or you see all of a sudden everybody has a certain phone, there's a trend, or everybody's using a certain website, or everybody is, you know, when you see a trend, take note, because there's something brewing in that industry, okay? But your next step is to go into research. Now, this is what I call, and this is mine, okay? This is not the literature. I have designed this over the past 14 years of investing, of making lots of mistakes, okay? And the first thing I want to say is, this is how it's not an exact science, okay? It's where I want you to focus your time and energy. The first thing that I want you to look at, so when you see the percentage at the top, that means the amount of time. If you have an hour to research a company, or you have if you don't know a company from a bar of soap, I would say you need about 3 hours to research it. If it's a company like ShopRite or Pepco or Mr. Price, or companies that the Purple Group, shouldn't take you more than an hour, 45 minutes to research that company. So it's not that hard, okay? So 75% of your time should be spent on the moat. And moat doesn't stand for anything. It's not EBITDA or FOMO or anything. Moat is an English word in the dictionary. It means understanding the business. I'm going to dig deep into the moat today, because that is the heart and soul of the business. Okay? Then we're going to go over to the very next step, is the financials. I am not going to spend 15% of my time today on the financials, because the previous webinar was dedicated to the financial statements. Okay, so you are going to go to YouTube and you are going to watch the video on how to read financial statements for super beginners. And that's where you spend 15% of your time. I always say, nobody needs a calculator when they are investing. If you do have a calculator, you're just being fancy. You need 5, 6, 7 numbers out of a set of financial statements. If you can find them and you can say, if I put these 5 numbers together, this is the story that they tell me. Because that's all it is. Numbers tell a story, okay? And because they tell a story, it's your job to find out, what is the story? Today, we are going to spend time on the valuation, because this is something you guys struggle with. The stock market is the only place where you volunteer to pay more for something than it's worth. Or when something goes on sale, everybody runs out the store. You do exactly the opposite of what you should be doing. And I'm going to show you 4 ratios. Again, these ratios have been calculated for you. All you need to know is, what does the ratio tell me? Should I be waiting? Should I be buying? Should I be walking away? Okay. Then I actually just posted this on FinMe Up this week. Is leadership. Leadership, you cannot invest in a company and not understand the leadership. Would you give money to someone that you don't know from a bar of soap? Me, I won't. I am not entrusting my hard-earned money to people I don't know. And I don't mean have a drink with Elon. No, I mean There are certain characteristics that that leader needs to have before I entrust them with my hard-earned money. And we're going to touch on that today. The share price matters the least in my life. 1% of my time. And I literally say 1 minute of my time. And this is what new investors do wrong, is you spend 100% of your time here. You look at the share price and you go, hey, it's low, I'm going in. Hey, it's high, I'm selling. You ignored 99% of research. How do you expect to be successful? How do you are gambling. If you spend 100% of your time, where successful investors spend 1% of their time, you're really not going to make it in this game. You can get lucky. You can get very lucky, but you're going to get lucky 1% of the time. And I don't want you to get lucky 1% of the time. I want you to be so focused on your portfolio that the share price doesn't move you, because share prices don't move me. Do you know what moves me? This moves me. This moves me. This moves me. This moves me. This thing is none of my business. Okay, so we're going to dig into that. I keep going to the chat. I just want to make sure that there isn't questions. I will answer that, Senzo, when we get to that spot. Okay, we'll get there. Okay. Now let's talk about the moat. I put a picture here to make it very easy for you guys to understand what a moat is. You see this castle here? That castle is your company. It's your investment. It's your coins. You see this water around it? It's called a moat. In historic times, they used to build cities, castles, and what they used to do is they dig deep trenches around it, okay? And they would even go as far as covering it with leaves so that their attackers can't see it. And it's an English word. You can go onto Wikipedia and you can find this very same picture. Buffett decided he's bringing this word into investing. And he said, I will not invest in a company where this is not deep. It must be deep. It must protect my company. And that is a moat. A moat is what is going to protect your company from attackers. Who are these attackers? Competitors, technology, pandemics, bear markets, interest rates, inflation. You need to know every company has different attackers, okay? COVID proved to be the great equalizer when it came to being an attacker. Interest rates are not going to affect everyone the same. A company that has no debt on its balance sheet, why would you stress about interest rates? They have no debt, okay? A company like, remember Blockbuster? And there was a Blockbuster on every corner in the United States if you've ever traveled to the United States. What did we call it in South Africa? We also had these video stores on every little corner. They gone because of Netflix, because of technology. So you need to know for your business, who are these attackers? You have to list those attackers as you are researching your company, list the attackers. Okay? I cannot tell, there isn't a universal list, because what is going to attack Renogen is not going to attack the Purple Group. They might be similar things, but they might also be completely different things. Renogen is currently in exploration phase. What if something goes wrong during exploration, guys? The risks are very, very high during exploration. Safety. So you need to know, how serious is Mr. Steph Marani about safety, about getting the gas out of the ground in the most efficient and safest way possible. If you think about the Purple Group and you think about competitors, I'm having this webinar and it's a Think Markets webinar. Think Markets is a competitor. They might not be listed, but they are a competitor to Easy Equities. The banks are competitors. Do you think the banks are not watching what Easy Equities is doing with no monthly fees, with low brokerage costs? Do you think the banks are just sitting there and saying, oh, we are so sad, Easy Equities is doing this, what are we going to do? Are we going to do nothing? No, they are not going to do nothing. You need to know who the attackers of your business is. Okay, now we are going to jump into the moat. Okay, there are more questions than this. Okay, this is not a laundry list, but I promise you, if you can answer these 9 to 10 questions for your business, you are going to understand that company. And if you answer these questions off the top of your head, leave research. Leave it. You're wasting everybody's time, especially your own. You need to research the answers to these questions. And the first question is, does the company sell a unique product or service? Now, somebody's going to say to me, but I can answer this off the top of my head, Sol, for ShopRite. There's nothing unique about groceries and furniture, etc. There's nothing unique about it. I didn't ask you if the product or service is unique. I asked you, does the company sell a unique product or service? And you can't answer that for ShopRite unless you are a ShopRite investor like myself and you've researched what makes groceries, financial services, the Africa strategy, the Middle Eastern strategy, the distribution strategy different at ShopRite than at Woolies, than at Pick n Pay, than at Spar. So do not come at me and say, oh, there's nothing unique about electric cars. No, there's nothing unique about electric cars, but that's not what I'm asking you. I'm asking you, does NIO sell unique electric cars? Is there something they are doing that is different than what Tesla is doing, than what General Motors is doing, than what Porsche is doing? Okay, so do not answer this question off the top of your head, because if you're going to send me your research, I'm going to rip it apart. Because I'm going to say, but I didn't ask you if stationery is unique. I asked you if what the company is doing to that product or service is unique. Okay, so this is the one question, and it's the most important. I'm going to give you the second most important, or a few questions later. So We are going to look at Celsius as an example. I'm going to use different companies, okay, to illustrate points to you. But I also want to bring it home to you with one company where we look at everything, where we say, this is not unique, but look at these damn financials, or this is not unique, but look at the brand. Oh my God, people are going crazy for the brand. And I don't have a scoring system. Ask any of my students, some of them are here in this class right now. I don't say 1 out of 10, 3 out of 15, 6 out of that. There are people with extremely complicated scoring systems. I don't do that. I don't complicate investing like that. I look at the overall story, and then I'm like, this company is actually an awesome investment. But if there's one thing that is missing for me, I walk away, no matter how awesome you are. Okay, I'll talk about that later. The next question you need to ask yourself is, and this is where competitors come in, and do not be fooled by only looking at competitors in your industry. Companies have failed because of this. How easy is it to copy what that company does? You have to research it. Let's use Tesla as an example, because when you ask any Tesla investor, how easy is it to copy what Tesla does? They're going to say, it's impossible. The cars are unique, the S model, this model, that, the Elon, they just go mad, okay? I'm telling you, it's very easy to copy what Tesla does. Why am I saying that? I might not give them, so I have a 1 out of 3, it's not there. 2 out of 3, it's neither here nor there. 3 out of 3, full marks. You score full in my books, because I just need to keep a train of thought of, this was not there, this is neither here nor there, they kind of average, and 3 out of 3 is full marks. Okay, so let's see if there's any questions. How many people are going to ask me about, guys, please stop asking me about SWOT and PEST, etc., etc. This is an investing lesson. I am not going to take it back to school. I'm trying to teach people principles, okay? And understanding the moat has nothing to do with pistol or with SWOT, okay? It is simple questions that people need to answer. Because if I tell somebody, write the strengths, the weaknesses, the opportunities, and the threats, people are not going to know where to start. Guys, these are new investors. They are here to learn. So if I say do the pistol analysis, I'm going to scare some people away. And I don't want to do that. Okay, so if you have gone to business school, etc., etc., that's amazing. You can add that over and above this. But I'm giving people simple questions to answer, and I'm going to show them where to find the answers. Because literally, if I say to a new investor, write the opportunities, but I don't tell them how. I am the how person. I'm the person that tells you how easy is it to copy what the company does. That is something somebody can understand. Me giving them 5 headings is not going to help them, unfortunately. Okay, so if this is too basic for you, then that's okay. I'm trying to help people who really struggle with what must I look at. So let's look at something else. How easy is it to copy? So I've already I said Tesla, nah? Why did I say that? Because for me it is like If I was BMW, and we're going to get to the next question right now after this, okay? Think of BMW and think of how loyal customers are. If you are a BMW fan, guys, there's nothing I can do about it, okay? You are a BMW fan. But let's talk about how easy is it to copy what Tesla or NIO does. There's something called reverse engineering. And if, let's say, the CEO, COO, Chief Operating Officer, we're going to talk about those people later, you know, they decide to buy a Tesla. They buy that Tesla, they drive it off the showroom floor, and they drive it straight to their factory floor. BMW has access to the world's best engineers. And I mean software engineers, electrical engineers, every type of engineer or scientist you can think of. BMW has access to them. They already have a very strong brand. If they put that car on their factory floor and they reverse engineer it, they take it apart to see how it was put together. And then they build a Tesla and they slap a BMW badge on it. What do you think the BMW drivers are going to buy? If they are getting exactly the same thing, they don't know. They don't know. But because VW and BMW and Ford drivers are already loyal to their brand, don't discount reverse engineering. The other thing is, I always tell people, you know, I used to suffer from chronic depression and my tablets used to cost like 1,200 Rand a month. And then one day I went to the chemist and the pharmacist asked me, would you like the generic? And the generic is 40 Rand. So obviously I took the generic because I'm going to pay 1,200 Rand if I can pay 40 Rand for exactly the same thing. And that's exactly the same thing in the pharmaceutical industry is, you know, while they are developing a tablet, they spend, and we're going to talk about it later, they spend excessive amounts of money on research and development and marketing that tablet, okay? And obviously getting it into hospitals and getting it into, you know, getting it into doctors' rooms and having doctors prescribe it. They spend so much money, these reps going to the doctors' rooms with their little cases and their pamphlets and stuff. Now, if Aspen is doing that and it's spending so much money, the pill is going to be expensive. And then what governments do is they obviously give the company a patent, you know, a trademark, where for 10, 11 years, 7 years, depending on how long the trademark is, nobody else can make that tablet. Nobody is allowed to make it. And that's what a trademark is. It protects you because you've spent all this money on research. You need to make it back. But do you think while Aspen is coining it from Sol every month, 1,200 Rand a month, and from all the other people, you know, who suffer from this disease that I suffered from, do you think the other drug makers, Johnson & Johnson and, you know, who's the other one, all the other drug companies, do you think they're just chilling and they're just saying, we are so sad, why did they do this? You know, we can also make it. All they do is they go to the pharmacy and they buy that 1,200 Rand tablet. They take it to their lab. They reverse engineer it because they can see exactly what's in that tablet. And then they wait for the patent to expire. So the month before that patent expires, remember now these guys are spending nothing on research. They're spending nothing on marketing, okay? All they're doing is copy pasting. And then they put that pool together and they make thousands and millions of batches. And the day that patent expires, the next day the generic is in the pharmacy. And I pay 40 Rand. That's reverse engineering. So you have to ask yourself, for any company that you invest in, how easy is it to copy what my company does? You know, if it doesn't matter what company it is. Can there be another Easy Equities? How many of you know that Easy Equities has a patent for fractional shares in South Africa? Nobody else is allowed to sell you fractions because Easy Equities went and patented it. But the patent is not going to last forever. So if you want to buy one Amazon share, let's take a Google share, that is $2,000. If you want to buy, I can't even remember, did Google do a split or something? I don't know. But let's say we have a share of $2,000. That is over 30K. If you want to buy it on FNB or on Standard Bank or any of the other banks or any of the other trading platforms, you have to buy a whole one. And that's very impossible for the average investor. And Easy Equities was extremely clever in patenting fractional shares. Wasn't their bright idea. Basically, every company in the United States does it, but nobody else was doing it in South Africa. But the patent is not going to last forever. Patents and trademarks expire, guys. They have a useful life. So do you think the banks, when that patent expires, is not going to start offering fractional shares? Because then they can steal us. Because right now, we can't buy an Naspers share because it's 2,000 Rand and we don't have 2,000 Rand. But when that patent expires, we can buy it with the banks because they are not just going to sit and do nothing, and they are going to advertise. So think about how easy is it to copy what your company is doing. Ellen, you can't just renew patents because then they would do it for all medicine, for everything. So you can renew patents, but not for exactly the same thing. So no country or law is going to allow you to be the only one forever. That is anti-competitive behavior. And nobody, no country allows. That's why we have a competition commission. Do you think FNB and Standard Bank, Global Trader, is going to be okay with them doing this forever and being anti-competitive? No, guys. It doesn't work like that. That's why it doesn't even work for the medicine. You have a chance. You obviously started this platform. You needed to, to make your money back. You built this platform. It was complicated to create, fractional shares. It's not easy because I don't know if you know, but Purple Group can't go to the JSE and ask for half a share. They need to keep a stash so that if I want half a Naspers share, Charles already has it because he can't go to the JSE. You can't go to the JSE and ask for one share. Okay. If you want to see where patents are, Timothy, the financial statements, it's a note called intangible assets. Because it is an intangible assets. Okay, we've already talked about how loyal customers are to the brand. But what I want to help you guys with is, let's say you are researching a company that you don't know how loyal customers are to the brand. If I have to ask you, like I'm an investor in SoFi, for instance. SoFi is banking in the United States. How am I going to know how loyal customers are to the brand? I don't know. There's something called a customer retention ratio. Okay? And let me tell you something about companies, because I've been working in listed entities since 2002. Companies love bragging about their customer retention ratios. It is, do they lose customers, or do they grow their customer base, or do they have repeat customers, etc., etc. Companies love bragging about it. So if you go onto any company's website, let me go off again. I just want to show you, if ever you want to find anything, okay, type in the company's name and add the words investor relations. You see, SoFi investor relations. Okay, hit enter. The first page that comes up is the investor page. Remember what you are. You are a potential investor. You're not here to open a banking account with SoFi. You're not here to go to the SoFi Stadium. You're not here to do the SoFi money dance. You are a potential investor. So you need the investor relations page. Okay. The investor relations page of a website is the first place I go to when I do research. Why? I don't go to Wall Street Journal. I don't go to the JSE website. I don't go to Seeking Alpha. I don't go to investing.com. I don't go to the Motley Fool. I give a crap. Those are over and aboves. The first place I go to when I look for information on a company, when I start my research, is the investor relations page. Okay. Now, this is the investor page. Most investor pages, guys, they look 99% similar. Someone will try to add in something fancy here and there, but they look exactly the same. So if you've seen one, you've seen them all. So there's an overview, there's news, there's events and presentations, there's stock information, there's financial statements, there's some information on governance, leadership is normally in there, and then there's some resources. Okay. This is the first thing I'm going to beg of you. I'm going to beg you to do this. If you are invested in any US company, South African companies are horrible at this, okay? But if you are invested in any US companies, go to this thing here called email alerts, okay? It says investor email alerts. Come down here, put in your email address, okay? Then you say, I want events and presentations. I want quarterly reports. I want annual reports. Please, for the love of God, do not click SEC filings and end of day stock quote. Your inbox is going to be flooded with information. Okay? Do not do it. I can't do this again now because I'm already subscribed to SoFi investor relations, but put in your email address, events and presentations, the quarterly reports and the annual reports. It means you're going to get the financial statements. Okay. If you want to do news is nice because you will learn a lot about the company every time the company is in the news. If it's a company like Amazon, guys, I am not going to subscribe to news. Amazon is in the news too much. But if it's a company that I really, really need to track, especially a company like SoFi, then I'm going to click on news. Okay. Then David, please go to the financial statements of Easy Equities and all the information will be in the intangible assets note. I had a session on financial statements, so I don't know off the top of my head. It expires when it expires. But all the information, these things are not secret. They are in the financial statements of a company. Okay. Just go to, if you see on the face of the financial statements, you will see intangible assets. Next to it will be a number, maybe the number 12 or 13 or 21. Go to that note, read the note. The information will be in there. So do this, and then you're going to get. Let me show you. If I go to my email, let's type in one of my favorite companies. I always like to switch it up. Let's type in Gevo. Gevo is it's my renewable energy play. I just type in Gevo in my search engine. Look here, so that you guys don't think I'm lying when I'm saying what I do. Look here. Gevo, new form 10Q. Okay, so if you were in the previous lesson, you would know a 10Q is a quarterly report. Okay, you would know what an 8K is. You can see Gevo report second quarter. Here you can see I subscribe to news. Alaska Airlines and Gevo enters into sustainable aviation fuel sales agreement for 37 million gallons per 5 years. So Gevo makes sustainable aviation fuel out of corn, okay? And not corn that's used for human consumption. It is a much, it's a very different corn. There you can also, that is the sustainable, yeah, this was my fave. Gevo helps American Airlines join the leading edge in sustainability. And yeah, it is not 37 million, it's 100 million gallons of sustainable aviation fuel for 5 years. Okay, so for any of your companies, if you are like me and you're also an upstart investor, you can go to your emails, you can see there. So there's a lot of other people who write on Upstart, but if you can see there, this is Upstart. Alliant Credit Union selects Upstart for personal lending fintech partnership. If I go out, and that's when they announce the second quarter results. That is, yeah, it says, okay, Upstart Auto Retail. So Upstart Auto Retail named fastest growing digital retail software for auto dealerships. So that's what I want you to do. Go to the financials, go to the company's website and sign up for investor alerts. Okay, now we're going to go back to SoFi quickly because me, I'm a digressor. Okay, so when you are here at the top, you have events and presentations. Remember, we were talking, what were we talking about? We were talking about customer retention ratios. How do you know if people are loyal to the brand? Okay, please, please ask your questions in the Q&A. Okay, I'll answer that one just now. So let me just go through. What is if the stock is up? No, Anele, a stock can be up 500% and I will still buy it if it's an amazing company. The share price matters the least in my life. I was just up, I think 120% on Celsius, and I doubled my investment when Pepsi made that announcement that Pepsi is taking a stake in Celsius. The share price matters the least in my life. I can be up 500% on Amazon and still buy it because the moat is strong. Stop looking at share prices because winners have a way of keeping on winning and losers have a way of keeping on losing. Doesn't the share price a leading factor of how the business is performing? This is the funniest question ever. No, the share price is not the leading factor of how a business is performing. The moat, the financials, and the valuation and the leadership is the leading factor of how a business is performing. A share price can be up 300% and profits can be down 50%. Why would you buy that business? Why? It means you're FOMOing because investors do stupid things. If you are going to look at a share price, you are looking at what the public is doing. Okay, so do not be fooled by the share price. Okay, this is definitely going to be on YouTube. Customer loyalty, that is something I am talking about right now. Okay, so we are here on the presentations. Okay, There's an earnings presentation here. I just want to see, I haven't been on the presentation side, this side a lot. So let me go to 2021. I just want to see if I can find the annual presentation. No, man, let's go to 2022. We'll find it. Let's see this one. See. Actually haven't looked at it because I actually watched the live. Members, okay? Second highest quarter for new members. So there you can see how the SoFi doesn't call their customers, they call them members, okay? So here you can see the year-on-year growth, okay? Products, you can look at the products there, you can look at the Galileo accounts. If you don't understand SoFi, these things are not going to make sense to you. But in these presentations, you are going to find how loyal customers are to the brand. You do not have to guess. Okay. Let me just quickly check if there's anything I am missing. I don't know who this is asking this question. I don't understand the question. It just says Galaxy S10. Is everyone, if everyone is doing it, isn't that the same as following a trend? I don't know what I was saying at that point in time. So I don't understand the question. I'm sorry. I'm sorry. If you maybe want to write the question just in a different way, Galaxy S10, because your name is not there, in reference to the share price. I reference to the share price. Let me show you guys something. You know, people will be insistent that what they are doing is clever. I'm going to show you guys something. A company that I made over 200,000 profit on. Let me show you guys something. How stupid people are. And people are, if you are going to follow the herd, you are really going to look at this company, Upstart. I'm going to go 5 years because I bought Upstart in December of 2021, in December of 2020. Okay. I bought Upstart at around $37, $38. Okay. Not a word of a lie. I can show you my F&B statement because Upstart was not on Easy Equities when I bought it. I bought it on F&B because I found the company and Easy Equities did not load it yet because Easy Equities only has about 800 US stocks instead of the full 15,000. Upstart went from $44 to 401. There's the 52-week high. What did I do? I bought this company because I believed in this company over the long term. Currently, the share price is 28. Now, you telling me the share price is an indicator of how the company is doing. Okay? This is what we call herd mentality. I sold my Upstart shares, by the way, and made 250,000 Rand profit of other people's stupidity. Let me go there and go to ticker. I'm going to show you. So ticker is where I go for my US financial statements. Why did I sell Upstart at $300 and bought it back at $30? Because there was no reason for the share price to go to 400. People were bored out of their skulls. See when look at when the share price jumped. Gonna go back there. Share price. Look here. December 2020, the company issued their next financial statements in December of 2021. Okay, there's December 2021, 151. In December of 2020, the share price was around $40. So $40 to $115. Okay, over a year. Look at the financials. Upstart's revenue increased from 2020 to 2021 by 200%. Okay? The operating income went up quite nicely. The net profit of the company went from 5 to 135. Was there any reason for the stock to jump like that? This company is still spending over 134 million rand in research and development. There was no reason on God's green earth why people had to push the share price to 400%. Not a single reason. This is what you call FOMO. This has nothing to do with the underlying numbers of the company. If you go to the balance sheet, remember, it's not just income statement driven, balance sheet driven too. Upstart is sitting on, let's look at 2020. Upstart was sitting on cash of 250 million rand. And if we go down and we look at the long-term debt, I normally compare the cash to the debt of a company, okay? So that I can see if the company is indebted, okay? Then I look at the long-term debt, and then I can also see they didn't have any short-term debt, which means the company still had quite an amount of debt, okay? Now look at what has happened to the debt from 62 to 700 million in debt. The share price had nothing to do with the numbers. The share price had everything to do with FOMO and social media, chasing up the share. And that's why I bought it here and I sold it at around 300. And I was like, these people are mad. And I bought my shares back around 30. I'm down about 3, 4, 5, 6, 7% right now. And I'm going to ride it again. But I expect this company, I just showed you in my inbox, I showed you that, let's go to Gmail. I showed you the reason that I'm buying the company is because of this reason. If we go to Upstart, okay, it's because of this. This is why I'm buying it. It is because of things like this. Mascoma Bank selects Upstart for personal lending. They select them. The revenue and the profits are going to come later. Next one. Sharon View Federal Credit Union selects Upstart for personal lending. This is only in May. The profits are going to come later. Maybe 2024, 2025. Mid-Florida Credit Union selects Upstart for personal lending. This company is growing. It had no business going 10x because that was just FOMO. So nothing in the numbers supported the growth in the share price. You need, if something like that happens, I still believe in my business, but guys, I also need to eat. I sell those shares and I buy them back later. And that's how, because I know the company. I'm like, there's no way in hell the share price should be $400. Are people mad? And you need to be able to know when to do that. I don't sell when something is 10% up, 20% up, 30% up. I sell because people are insane. People chase up. And you know what the beautiful thing is? They are fools who bought at 400. With no support in the underlying business for that jump in the share price. And this is why the share price doesn't, it's none of my business. Absolutely none of my business. Upstart has just increased debt tenfold. There's a reason the share price is $28. But this is going to be $100, $200, $300 stock in 5 to 10 years' time. And whenever you talk to me, do not talk to me in months. Do not even talk to me in 1 to 2 years. Then I'm not the right person to teach you because I think in decades. I'm building generational wealth, not wealth for next month or for December. I am a general wealth builder, generational wealth builder. How do I know when to sell? Because people are crazy and they chase up share prices because of FOMO. Is it good to reinvest your dividends in the holding or cash portion? I take my dividends. I don't invest blindly. So like I'm going to get a 60,000 Rand dividend from Thungela on the 26th of September. The chances are almost zero that that money is going back into Thungela. I'm very grateful for my dividend, but I'm potentially I'm going to see which share at that point in time is right for me to invest in. I never take my dividends out because I don't need them. I still have a job. Do you know how it takes? It doesn't take courage to sell, Ntombe. Do you know what it takes? It takes knowing your businesses. It takes understanding the moat. If a share price is chased up by crazy people, sell it and buy it back later. Why would you not do that? Because you know the share price is not supposed to be $400. You just paid $30 a few weeks ago. You know there's mad people chasing the share price up. People do crazy things, especially retail investors. Sell it and buy your shares back later. It's not that you don't believe in the business. Take out your profits, divert the money somewhere else, keep your original investment in your Easy Equities account, and then when it's time to buy again, just buy back in. It's not. It really isn't that hard. Okay, now let's move on. Isn't the minimum to invest depends on the share price? On Easy, I just showed somebody. I had a mentee the other night that's never heard about Easy Equities, and I had R2.75 in my account, and I think I bought the Resi ETF in front of him for R2.50, and I paid my 4 cents fees. There's no minimum. Whether you own 0.001% of a share, you're still going to get your dividend. Okay? So there's going to be a recording for anybody that missed something. Now let's go over, because I'm showing you guys live examples now. I'm not making up stuff. I'm showing you live examples. We've talked about the brand. Switching costs. Switching costs is how easy or hard is it for customers to leave your company? I want companies where it's hard to leave my business. Sticky companies. Why? Think of, let me give you an example. If you're in the mall and you need to buy a black jeans, there's Pick and Play Clothing, there's Woolies, there's Mr. Price. You can change your heart, you can change your mind in a split second, because it's $250 there, it's $230 there, it's $199 there. I'm going to the $199. It's just the black jeans. I'm going to dress it up with something in any case, with fancy jewelry or something. Easy to leave. Software companies are not easy to leave. Okay, imagine I run my entire business on Microsoft and Adobe. Do you think anybody can convince me to move over to iOS? Not even if you paid me will I move over, because I run everything on Microsoft. Okay, software companies, all software companies, they're really, really hard to leave. Even if you take a company like CrowdStrike, which is cybersecurity. Once you've built your entire business around CrowdStrike's cybersecurity, it's not easy to leave them. It really, really isn't. Okay. Remember, I don't know if you guys are old enough to remember that many years ago, If somebody had an 082 number, you knew they were Vodacom. If somebody had a 083 number, you knew they were MTN. Why? Because you couldn't take your number to another network. So MTN and Vodacom built this into their business models because they know if we make it hard for them to switch, they won't switch. And what happened? Like you guys asked earlier, can't they just renew the patent? And I said, competition commission. The competition commission straight up told them, you guys are stifling growth. How can you expect a business owner to stay with you if he's unhappy? And then if he leaves, he loses his number. And they overturned it and they forced them to be able to port numbers. So can you see how clever companies are? They build this into their business models if it's legal. Find companies that are hard to leave, my babies, please. Okay. Can you guys see my screen? Is it me? Okay. Then, okay, sorry, I'm pressing the wrong button. The next one is also about sticky companies. Does the company have recurring revenue? I love finding companies where they get paid monthly, quarterly, annually. Okay. And the reason for that is human beings are lazy and you need to capitalize on it. If you just think about it, if I say change your bank, the first thing that comes to your mind is my salary, my debit orders. Yes, I don't have the energy for this. Sticky. If, like, I'm currently using Zoom, I have all my Zoom licenses, etc., etc. If you tell me to move over to Teams, yo, guys, I don't have the energy because all my stuff is saved in the Zoom cloud. Sticky, because we're lazy. I don't want to do it. It's as easy as copying the stuff over, downloading and copying it over and paying a cheaper price somewhere else. But humans, that's just how we are. You know, if I say change your insurance company, you're like, yeah, I'll do it, but nah, not in the mood. The next, let me tell you how clever Elon is. A lot of people will say, you know, like if you buy your BMW and you pay for your 10-year service plan, 5-year service plan, sorry, not 10 years, 5-year service plan, work it into the finance, you never pay BMW a cent again. You take your car for service every 5 years. After the 5 years of review, you're like me, I go to Car Service City, I'm done with BMW. Okay. Elon is very clever. What he does is he will sell you a Tesla, but he never sells you a Tesla battery. Not a single person on this planet owns a Tesla battery except for Tesla. You rent the battery. Because he wants a recurring revenue. Also, the software that connects you to the Tesla network is a subscription. So you're gonna pay him every month, whether you like it or not. You're gonna pay the bank for the car, and then you're also gonna pay it for. Find companies, even companies like, you know, I mean, Uber has worked it in now, where if you like, normally you would like order on Uber and, you know, you'll pay your delivery fee, blah, blah, blah. Now Uber is clever. They say, pay us a monthly fee of 50 Rand or 65 Rand, and you can have unlimited deliveries. Why are they doing it? Because they want recurring revenue, because they know if you have that Uber pass, you're not going to use Mr. D. And that's what they need. Okay. Next question. How big is the company? Guys, the amount of fights I have with my mentees who send me their portfolios, with only miniature companies in it? Where are your fighters? If you are a small cap investor, take the risk. But if you want to build generational wealth, you cannot have a portfolio where this thing is a midget. You can't. Because the smaller this is, the easier it is to attack. So the first thing I ask is, where are your fighters in your portfolio? Where are your BHPs? Where are your Kumbas? Where are your Naspers? Where's your Amazon? Where's your Microsoft? Where's your ExxonMobil? Where is your Bank of America? Where is your Louis Vuitton? Where are your fighters, your Richmonds? You can't come and when COVID hits, you down 70%. Fighters don't go down 70%. So do stop filling your portfolios with tiny companies, because you are going to, the smaller a company is, the higher the risk. It's as simple as that. Okay? You're going to get lucky with one or two, but me, I don't have time for luck. Luck is not an investment strategy. You can have small cap companies. I have many small cap companies in my portfolio, but my fighters, I feed them every single month, whether the price is low or whether the price is high, because they make me sleep better at night. I like finding disruptive companies, because disruptive companies change the norm. I just showed you Upstart. If you're not familiar with Upstart, Upstart is they use artificial intelligence for lending. If you don't know, about 70% of people in America do not qualify for credit because of the legacy systems and how credit systems were built. And along comes Upstart, and they collect over, it was 10 billion data points, when I last looked at it, per person. They collect all your financial behavior, and they build rigorous models that when a loan is issued using the Upstart artificial intelligence and machine learning, the chances of that person defaulting is 0.01, which means greater access to lending. Upstart has now also, I'm very excited, the platform is in Spanish too, and Spanish is very important because the Spanish community is really, really excluded, from financial services in the United States. So platform is now also in Spanish. That's very cool. Disruptive. The banks don't like this. The banks like excluding people of color or people coming from certain backgrounds. Sorry, I just made my chair too low. So try to find disruptive companies that are going to give you exponential growth. The next question, and there's a reason this is yellow. Remember when I said, if you're going to do this off the top of your head, leave it. If you're going to do this off the top of your head, double leave it. Is there massive room for growth? Why are you investing if there's no massive room for growth? And massive is relative, okay? My massive and your massive is not the same massive, so please don't ask me for a percentage. I'm going to use Celsius as my example, my fave. I believed in this company at $30. I believed in it at 15 and I didn't buy it, only started buying it at $30, and it's now like $100 a share. Because the first thing I say to myself is the amount of influencer marketing that they're using. They have NBA players, they have pro surfers, they have fitness influencers with millions and millions of followers on Instagram. and all these people are marketing Celsius. What's the first question I told myself was, I've never tasted Celsius. I live in Africa. When are they coming here? Can they come here? What if they come here? People in Asia haven't tasted it. People in Australia haven't tasted it. People in South America haven't tasted it. 90% of Celsius's sales is in North America. And then 1 August, Pepsi comes along and Pepsi takes a 9% stake in Celsius. And guys, Pepsi is everywhere. I've just come back from Asia and I have a new love for Pepsi because they have very little Coca-Cola in Thailand and in Cambodia. They basically just drink Pepsi. Think about the markets this is going to open for this company. And then now people will say, but you're just lucky that Pepsi took this stake. Hell to the no. I studied this company. I was like, the products are all natural. Calorie burning, an all natural fat burning drink aimed at the fitness market. This is nothing like Red Bull or Monster or Rage. This is something completely different. I looked at the financial statements, not a cent in debt. Spending excessively on marketing because these influencers are not cheap. You know, they spend years building these platforms. But there was no ways a company like Coke or Pepsi was going to ignore this forever. It was just a matter of time. So when you research your companies, ask yourself, is there a potential for new products or services? Is there potential for new markets, new geographies? Discovery is very sneaky right now. I'm telling you guys. Discovery is slowly moving into China. And whenever somebody says China, all you need to do in your head, 1.4 billion people, 1.4 billion people, 1.4 billion people. That's all you do. Discovery is slowly making their way into China. And I am telling you now, 1.4 billion people. That's all you should think about. There's 59 million of us here. 1.4 billion. Think about it. Okay? Go and look on Discovery's website. What's happening? So you have to look if there's massive room for growth. And then I like this one. I got this off Buffett's list, actually. Does the company have first mover advantage? Think of your Amazons. Think of your Netflixes. Think of Coinbase. Think of Easy Equities, the Purple Group. Think of Renogen. Think of, there are so many companies. Because if you find a first mover, attackers struggle. Name a company to me right now that can attack Amazon successfully within the next year. I can't think of one that can take over Amazon in the United States. I'm not talking about take a lot. I'm talking about little people, okay? Name a company that can attack a first mover. Shopify can try. Mercado Libre can try. Find first movers. Okay, I'm just going to scan the questions. In the United States, Tamsakwa, Alibaba, please. Show me an American that is rather going to order from Alibaba. 90% of Americans moving to Alibaba versus Amazon. Good luck with that. Take a lot. Hey guys, I wish Take a Lot can. I wish Takealot can just get a competitor. They are charging us so, I don't think their prices are competitive, but we'll talk about that. Guys, that was the bulk of today's lesson. I am going to scan the next slides. I promise you. Just want to see. Let me answer Kabira's question, because you know how many people make this mistake. In terms of fighters, is it not worth considering that they have reached their growth potential? Me, I made this mistake. I paid my school fees when I didn't want to buy Amazon at $1,000. I refused. I said, it can't go any higher. And it went to 3,000. I eventually bought it at like 1.5 because like, I can't do this anymore. It is the company with the strongest moat I have ever seen. Do not make that mistake. Do not invest in your winners. Do not think because you are 100% up on something, you're not going to buy more. Because I'm going to say this over and over again. Winners have a way of keeping on winning, and losers have a way of keeping on losing. And it is true as faith in the Bible. This is the biggest mistake people make. They do not invest in their winners. They rather feed their losers, trying to get to zero, like scrambling. If I buy more of this loser, why would you do that? It is the dumbest thing ever. Okay. Ibrahim, I have only sold, in the past 10 years, I've sold Futu because I made a mistake. I was overexposed to China. I cannot think of another company I sold. I was never invested in Steinhoff, but if I was, I would have sold it because I don't invest in companies where there's fraud. I don't. Unless there's a mistake. I can't think of a company that I've sold in the past 10 years. Before 10 years, I think I might have sold because I was an idiot and I didn't know what I was doing. Okay, financial statements. I said you guys must go and look at the previous, okay, this is the financial statements. We're going to get to valuation now. This is where I say, where you guys love paying for things you shouldn't be paying for. Okay, it's important to know what you are paying for. Guys, there is nothing that you can control in investing except one thing: the P, price. The only thing you have control over is the price you pay. After that, it's in the hands of the gods. Okay? And that is why it is critical to know what you are paying for. You cannot just blindly pay for something. You know, somebody buying a original set of Nikes. Sorry, I just want to get a pen and paper. Somebody buying an original set of Nikes for, let's say, 2,000 Rand versus somebody buying a fake pair of Nikes for 2,000 Rand is not in the same position. And that's what some of you are doing. You are buying things where you are not getting any value out of it. I put my pen in here. My daughter steals my pens. So I'm going to teach you the 4 ratios. And if you don't understand them today, it is okay. You are going to keep practicing. I'm going to also show you where to find them. You don't need to calculate them. I'll show you how they are calculated, but you never need to calculate them. So just remember, the only thing you have control over is the price you pay. So let's move to the price to sales ratio, okay? The price to sales ratio is basically, remember what I said, the market cap of a company over the sales. So the market cap is the value of the business. If you think about how market cap is calculated, it's all the shares that's, let's say a company has 1 million shares and the share price is 2 Rand. The market cap is 2 million. Okay? So the market cap is the value of the business according to the market, not according to the financial statements. Okay? So it's the market cap of the company. So the share price multiplied by the number of shares over the sales. And that's why I'm saying it's price over sales. Price is what you pay. Sales is what you get. And that is why I use the Nike example. You need to make sure that what you're getting is worth what you're paying for. And this is what a valuation is. A valuation is, what am I paying versus what am I getting? Okay? So you are paying the price for the sales. Okay? I'm going to give you an example because I think examples work better. If a company has sales of 50 Rand a share, so this ratio, please don't confuse yourselves, okay? If you are putting the share price there, you need to put the sales per share below the line because that's how division works. You can't put the market cap there and then the sales per share here. Or you can't put the share price there and the annual sales below the line. If it's per share above the line, it needs to be per share below the line. But as I said, you don't need to calculate it. But just for my example purposes, if a company has sales of 50 Rand a share, okay, and you are paying 1,000 Rand for the share, so you are paying 1,000 bucks and the sales is 50 Rand. The price to sales ratio is 20. Okay? What does that mean? It means that if this company keeps sales consistent for the next 20 years, you're going to wait 20 years to make that 1,000 Rand back in sales. This is a way of comparing 2 companies to each other. Okay? Always remember that. You're not buying from the company. So the money is not coming into your bank account. It's a way of comparing 2 companies to each other. If company B has sales of 400 Rand per share for the year, and you are paying 1,000 bucks for the share, the price to sales ratio is 2.5. So if company B keeps up the 400 Rand sales every year, you are going to wait 2.5 years for company B to make your 1,000 bucks back. Who do you want to buy? Do you want to wait 20 years or do you want to wait 2.5 years? That's the only question you need to ask yourself. Because me, I want to wait 2.5 years. I might be dead in 20. There isn't, because I know it's going to be in the comments, what should the number be? Should it be 1? Should it be 2? Should it be 20? Should it be 30? I can't tell you because you need to compare it to the industry or its competitors. I cannot compare Apple to ShopRite. I have to compare Apple to its competitors. I have to compare ShopRite to its competitors or to the industry average. If the industry average is 2 and Woolies is 20, goodbye, miss me. I'm not waiting 20 years for you to make my money back in sales when I can get another company who's going to make it back in 2. This is a valuation tool. This is how you compare which company is cheaper. You can't look at the share price. Because if you're saying, hey, this one is $1,000 and that one is $1,000, you know, I can choose whichever one. You're making a grave mistake buying company A, especially if they are in the same industry. You're buying the loser. You're not buying the loser, you're buying the more expensive company. And this is exactly why I say understand what you are paying for. Okay. Now let's look at the next one. Once you understand the price to sales, guys, the others are so easy. Okay. And then I'm going to show you where to find them. Now let's look at the PE ratio. This is the one that gets the most attention, okay, from investors. But I'm going to show you my favorite one is the last one. So the PE is the price you pay over the earnings. If you were in the previous lecture, you would know. Earnings means profits. Okay. Same word. It's a synonym for profits. So it is the price you pay versus the profits that you get. Okay. Now, let's do this. Company A has earnings of 50 Rand per share, and you are paying 2,000 Rand for the share. The price to sales is 40, which means if they make 50 Rand every year for the next 40 years, you are going to wait 40 years for that company to make your money back in profits. There's another 2,000 Rand share, but they are making 4,000 Rand profits per share. You're only going to wait 5 years for company B to make your money back in, sorry, this must be E, né? Sorry, it says PS, it must be PE, sorry, I made a mistake there, is 5. You want to buy the company that's going to make you your money back the fastest. Okay. You only compare the PE to the industry or to its competitors. You cannot compare, again, you can't compare Woolies to Amazon. You cannot compare Neo to SoFi, who's a bank, or to FNB. I put this as a disclaimer here because I like being truthful. I prefer PEs under 20, but I prefer PEs under 20, okay? I hate PE ratios over 20, but only, like I would never, ever for ShopRite pay a PE of over 2 because the industry average is 1 point something, okay? That's what I'm saying. I prefer PEs under 20, but only an industry comparison will tell you if you are paying too much for a specific company. Nothing else will tell you. You have to look at the competitors. Okay. Let me quickly show you. I just want to show you something. So I was on ticker here. Can you see when I'm on ticker? Sorry, if you click on anything on ticker, you know, a chart comes up, because some people like seeing visuals, other people like seeing, you know, I like seeing, oh, that's fine. Okay, so when you are here at the top, you must read the whole screen. I typed in the company name and I came straight to financials. But look at what is next to financials, the topic we are talking about right now. Guys, there are many, many websites that have already calculated this for you. Okay, I'm showing you an example. I cannot do all the websites in 2 hours. If you go to valuation, click on it. Here you can see multiples, street targets, but I want you to click on competitors. When you click on competitors, you can see Upstart has a, so let me also make this a little bit bigger. I want to show you something in accounting that a lot of people don't know. If I go to the financials, no? Can you see here's a column that's called LTM? This means in accounting, last 12 months. This is a full year, a full year, a full year, a full year. This is also a full year, but it's not running from 1 January to 31 December. This is the latest information. It's a rolling 12 months because companies issue financials every 3 months in the United States, which means the last 12 months is running from 30 June to 30 June, because Upstart just released their 30 June 2022 financials. And the reason that I'm showing you that is because when we get to the valuation, valuations are forward-looking. And when you look at it, you know what? Let me choose a company that has more competitors. Let's choose Apple. Okay? I want to show you a company that has more competitors so that you can see these street targets, etc., etc. Go and play around with these websites. It is for free. When you get to competitors, can you see Apple is highlighted because that's the company we are busy looking at. Okay. Now it says NTM, next 12 months, forward looking. Financial statements are backward looking. Valuations are forward looking. Okay. So that's what the NTM means. Total enterprise value is a fancy word for market cap. That's all it is. Revenue is a fancy name for sales. That's it. So what is this? This is the forward-looking price to sales ratio. Apple is 6. We have Xiaomi there. We have Hewlett-Packard. You can even, Apple plays in different industries. So if you only want to look at Apple's competitors in software, click on software. Then you will see Microsoft comes up, Oracle comes up, Adobe, SAP, all of them. Okay. Now you can see, you can even sort them from small to big or big to small, or however you want to sort them. Then you can look at, you know, it tells you there's 40 companies on this list. You can say if you want to see all of them on the same page, it just gets very, very messy. I'm normally only interested in the top 10. But here you can see, you know, Adobe price to sales of 10 years. I say it in years in my head because that makes sense to me. Is I'm going to wait 10 years for Adobe to make me my share price back in sales. Okay. Apple, you're going to wait 6 years. Then there's quite a few of them. You can look at them. Then don't stress too much about EBITDA. I'm not touching on that today. Okay. There is the PE. Okay. So it is the next 12 months price over earnings. And this is the reason that I do this with you guys. Many people will ask me, so why must I care about a price to sales ratio? Why don't I go straight to the PE? And here's your reason. What if this number is negative? What if it's a loss? Are you going to wait negative years? Does something like minus years exist? No. So I need to give you an alternative that if you are comparing loss-making companies, if a company is profit-making and another company is loss-making and you still think it's a good investment, look at the price to sales ratio. I'm giving you an alternative. Which one is going to make you your money back the fastest? Okay. I don't know what that question means. Okay. Then we have the price to earnings ratio. Now let's look at one of Mr. Buffett's favorite ratios. I don't give it, I don't give it enough attention. I should. I'm very guilty of it. But it's the price to book ratio. And if you were in the previous lesson, you will understand what is the book value of a company. Okay, the book value of a company. So remember, I told you this is the value of the company according to the market. Okay, the share price of the company on the stock exchange. The book value of a company is the value according to the financial statements. So if you take the assets of a company and you deduct all their liabilities, you get to the book value of the company. Buffett compares what the market values the company at to what the book value of the company is. Now let's have an example. Okay, let me show you. Okay, so this is typically, you will always find the market value of a company is higher than the book value. Okay, if you find a company where the market value is lower than the book value, you've potentially found a gem. If it's under 1. So if this value is 90 and this value is 100, you've potentially found a gem. And I'm saying potentially because it's not a given. It's not a given. Remember, there's things like accounting rules and accounting irregularities and blah, 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 because you're now relying on financial statements. But I'm saying that if this number is under 1, pay attention and go and dig. Why is the market saying the company is worth less than what the financial statements are saying the company is worth? Okay, so let's look at an example. So if a company has 100 million in assets and it has 75 million in liabilities, then the book value of the company is 25 million. Okay, I said assets minus liabilities gives you the value. Sorry, it's like your personal net worth. All your assets minus your liabilities is what you're worth. Now, if the company has 10 million shares, each share would be 2.5 million. That's what it should be. Okay, because that's the book value of the company. But if the share price is trading at $5, so the number above the line is 5 and the number below the line is 2.5, then it means you are paying double what the book value of the company is. Are you comfortable paying double what the financials are saying? That's a question only you can answer. Is if the financials are saying a company is worth 100, let's say 25 million in our case, are you comfortable paying 50 million? You should ask yourself why. Because I'm saying all of these things about accounting, etc., but we also have extremely amazing and diligent audit firms. Management is, I always say this to people, inherently, management are good people. It's our job to root out the bad, but 99.9999% of people want their businesses to succeed, want good corporate governance, want the financial statements to be a fair reflection of what's happening in the business. I do not build investment strategies around the 1%, the 0.1%. I don't. I build my investment strategies around the norm, around what generally happens. Maybe I'm an optimist, but I've worked in listed companies for long enough to know that we want to do what is right for investors. Okay, I just need to, I don't want to keep you guys for too long. Okay, the price to cash flow. This is something I don't often share with my classes because people struggle to understand it. I think I do have an example. Okay. Again, price is what you pay. I want you to, and I'm moving a little bit into the previous lesson. Earnings is profits of a business. Okay. And the profits of a company is not cash, guys. That's a very important thing to understand. I hope you guys can see this. I moved very fast past it. See where this crazy guy is. Hope you guys can see it. But in the year 2021, Tesla made a $5.6 billion profit. Okay? But that does not mean they made 5.6 billion in cash. You have to understand the difference between profits and cash. Here's a list of things. And I'm not going to dig into it again because I've already done it. Things like depreciation, amortization, stock-based compensation, inventory write-ups and write-downs, and non-cash interest crap. These things are non-cash. It gets you to a number called cash from operating activities, which is 11.5 billion. So even though Tesla's income statement, right at the bottom, the earnings is 5.6. This man made 11.5 billion in cold, hard cash. That's a massive difference. And these numbers are not secret. I took this from Tesla's 10K report, which means he made 11.5 billion in cash, even though his profits are just 5.6, because he has all these accounting entries. These are the things that keeps me employed. It's calculating all this rubbish. This is the thing, chartered accountants, why we have jobs. It's complicating people's lives, okay? So I wanted you to see this. There's a huge difference between the net profit and the cash of a business. And what is the common saying? The common saying is not profit is king. I've never heard that. Cash is king. cash is king because I can manipulate profits. You know, let's say when a bank makes massive profits in a specific year, you know what they can do if they want to smooth their profits because they don't expect to make good money in another year? Write down the loans. Just put through a bigger impairment on the loans because you can reverse that impairment next year when you have low profits. This is the most easily manipulated number in accounting. And I'm telling you guys, industry secrets, né? And we can run circles around auditors and explain it with memos and documents. And we can literally run 10,000 models to show that that impairment is valid. Because let's say we made a 10 billion profit, but next year we know yours is going to be a cuck year. We write down the impairments this year and reverse it again next year so that we smooth profits. So this is the most easily, but this number, that impairment would have been highlighted here. Cash is king. So that's cold hard cash. So that is why I wanted to share with you guys today. Look at the price you pay versus the cash that you get. And let's look at an example. Yeah, I say again, the market cap of a company is 10 times 100, gives you 100 million. If the operating cash flow, remember that 11.5, I told you it's cash from operating activities, okay? We call it operating cash flow. If it is 200 million, the ratio is then calculated like this. You take the mil and you divide it by the 200, which means it's 5. Okay? I'm going to go slow. So the market cap, this is the shape, this is the price you pay. Okay? Share price. They have 100 million shares, which means that's the value of the company. Okay? Market cap of the company. The company only has cash of 200 million. So what do? We take the market cap and we divide it by the share price. The market cap divided by the cash flow gives us a number of 5. This means that the company's investors are willing to pay $5 for every $1 of cash that the company makes. That's all it means. Now, I want to show you something that is very, very critical. We are almost at the end, I promise. Jane is making me laugh. Yeah, you need to watch this and you need to watch it slow. Also, what you need to do is watch it in tranches, guys. Don't watch, this is a whole webinar, so it's a lot to take in. Watch maybe the first 3 questions on the moat and then go on with your life. Make notes. Watch the second 3 questions, go on with your life. You know, watch the valuation, maybe the first 2 ratios, make notes, forget. Watch it over a week. Don't give yourself 2 hours to watch it because you're going to be overwhelmed again. Be patient with yourself. This is a journey. Okay. So I want you to look at cash. Cash is king. And again, you calculate this for one company, or it has already, I showed you on ticker, it's calculated for you. Let's go out again. Showed you there. If we go to there, can you see? There it is over the cash flow. So you don't have to calculate any of these things. Don't calculate it. You just need to know what it means. Okay. Let's go back. Now let's look at leadership. I hope you guys have the Fin Me Up app. If you don't have it, please download it because it's now available on all the stores. Okay. Leadership is very important. We entrust them with our money. So there's just a few things that you need to check. Is you obviously don't want, Charles Savage, who's the CEO of Purple Group. Imagine how tomorrow he's the CEO. They put him at BHP Billiton. It doesn't make sense, guys. I'm not saying Charles can't be an amazing CEO anywhere, but the value of networks, of industry knowledge, etc., is just, you can't buy that. You literally can't buy it. Charles has over 30 years experience in financial services and fintech. Then you go put him at Kumba. No, make it make sense. Okay, so look at experience that your CEO. And when I speak leadership, please, I don't speak about Exco. I don't speak about middle management. I don't care who's the head of IT. There are only 3 people who matter. It is the CEO, the person who makes the decisions. I don't even care who sits on the board. It's none of my business. A board comes in 4 times a year, makes decisions and makes strategic decisions that the company has put together, and they leave. I need the people who are there day in and day out running my money and making decisions about it. So it's the CEO, decision maker, the CFO, the money maker, and the COO, the operations guy that makes sure everything runs smoothly. CEO, CFO, COO, the rest of them, nobody cares. Okay, then I want you to look at the track record of previous successes. Guys, if somebody has a track record of being successful, again, Elon, the boring company, Neuralink, SpaceX, Tesla, PayPal. If somebody is successful, they're successful. Also, look at the CEO of Palantir. Guys, if you look at history has a way of repeating itself. Okay, if you haven't watched the documentary on Netflix on Elon, the way NASA doubted him and SpaceX, everybody thought he was insane. But you need to be a little bit insane. Now NASA is using SpaceX because SpaceX is the only company that knows how to reuse a rocket. They have figured out how to land a rocket perfectly after it takes off, which brings the cost down almost 95%. Okay, so that's just a fun fact for you guys. Then the next one is ethical values. I told you guys earlier, if there's something that is not there in a company, and ethical values is the one for me, is if there's any history of fraud, accounting irregularities, I won't touch that business. You can give me Steinhoff for free today, and I will say, burn it. I don't care. I don't want it. Because I don't care how strong a company is. If you cannot trust management, then it means you cannot trust the numbers. And if you cannot trust the numbers, walk away. It is not worth it. There are 30,000 other listed companies on the planet to choose from. Why would you risk it? That is me. If you are okay and you have forgiven and you have a forgiving heart and it's not really important to you, that is also okay. But ethical values, it doesn't mean he cheated on his wife. This is fraud, okay? I love finding founder-led companies because they have serious skin in the game and passion. And that's the two that I'm talking about here. Is for companies led by its founders, chances are they are extremely passionate and they will do anything to make that company succeed. I love my leaders to have significant skin in the game. If they hurt the share price, they must also hurt. I can't hurt alone. Okay. I do look at the REM structures. I love my CEOs and CFOs to get paid more in shares than they do in cash. Because again, I need them to hurt if they hurt the share price. And then the last thing that I look at that can make or break a company's culture. So for South African companies, it's a bit difficult, but for US companies, you will see in my FinMe Up write-up, I have talked about, I talk about Glassdoor ratings where companies' cultures are rated. In South Africa, you know, I read the news every single day. I have a subscription to the Business Day. So every single day I read the news. If there's anything funny happening in companies, very seldom, this doesn't really happen, but you can tell a lot about a company's culture from the news. I just want to make sure that I haven't missed anything important. I just want to make sure I haven't missed anything important. Okay. If you want to use any of the platforms for South African stocks, they are available, but you have to pay the $39 subscription. I'm too cheap. I rather look at a company's financial statements on the company's website. So Ticker is available for all stocks on the entire planet. You just have to pay the monthly subscription. For US stocks, it's free. Okay, share price matters the least, but it does matter. And again, winners have a way of keeping on winning. Losers have a way of keeping on losing. As I said, I was cheap. I didn't want to pay $1,000. I didn't want to pay $1,000 for Amazon. Look at me now. Okay. Now somebody's going to say, okay, but Ascendus is down 96%. How much lower can it go? Guys, if a share price is not 0.00, it can go lower. So never, ever make the mistake of saying it can't go any lower or it can't go any higher. And even from the questions in the chat, I can see that a lot of people are still focused on the share price. Even though I'm telling them it matters the least, they are still going to focus on the share price and think that the share price is representative of what's happening in the business, that it is the biggest driver of what's happening in the business. The past hour and 15 minutes is the most powerful indicator of what's happening in the business. This thing is just the result of all those things. So I normally look at 5-year performance. You can look at 10, you can look at whatever you want to look at. I look at 5 years because that really tells me a nice story. Then if I am looking for dividend stocks, I would look at the dividend ratios. Okay, it's normally together with the share price information. So if we, for instance, go, so if you're not using the stock screener, I suggest you use the stock screener, you know, for dividends. But if you quickly, like for instance, just want to check, does Kumba pay a dividend? You know, like you just put in Kumba share price, enter, and a graph comes up like this, and then you can see there, Kumba pays a 14.25% dividend. It's right there, okay? The PE is there, and the dividend ratio is there. So if you just want to quickly see, if you don't now still want to go through a whole stock screen, blah, 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 just go to Google. Google is your best friend, okay? That is really the bulk of what I wanted to cover today with you guys. I know, promise, I know it's a lot. We've looked at the moat financial statements. We have a whole webinar that's on YouTube. We've talked about the valuation, and I know I made your head spin, but that is the only way you can tell if you are paying too much or too little, because you have to compare what you pay, which is the only thing you really control is what you pay, but please compare it to what you get. And you get sales, you get earnings, you get the book value, and you get the cash. Those are the 4 things you're getting. When 4 things you're getting when you are paying the price. And before you pay the price, make sure that you are happy with those 4 things. Compare them to other companies. Okay. Then leadership, we looked at quickly. There's a really nice article. I'm also going to do another article for you guys, because a question I get a lot is, should I panic when leaders sell their shares, when insiders sell their shares? I will do an objective write-up of when you shouldn't care and when you should care. Okay, I'm going to try to put that out next week. I have a to-do list of note, so maybe later, maybe in 2 weeks time, but it's on my to-do list, because I know some people stress, or they will see on Facebook, you know, that Charles is selling his shares or Gary is selling, and then they lose their minds. I will tell you when to panic and when not to panic, and then we looked at the share price. Okay, I have tried to really look at the questions and answers. I know sometimes it is a little bit overwhelming. I can't get to all the questions, but if you have registered for this webinar, you know, you would have my email address. And if there is something that's really, really pressing, you know, for you, pop me a mail. I normally respond to my mails once a week. You know, I read a mail, I mark it as unread, and I get back to it. I just have bulk days where I try to respond to email. So if there's something really pressing and you want to chat to me about it, pop me an email. Let me just stop the recording.